Welcome to another episode of Bulls, Bears, and Blockchain on Revolution Radio, making smarter financial decisions with your host, Rob Nelson, former Fox News host and anchor at Roundtable Media with his team of market masters, Marc LoPresti, Managing Director of Moneta Advisory Partners, co-founder of Battlefin, leading data platform, and a former institutional equities trader at Lehman Brothers, Alex Mascioli, founder of Trade the Chain, former head of institutional prime brokerage at Bquant, John Najarian, co-founder of Market Rebellion, former co-host of Halftime Report on CNBC, and co-founder of Option Monster and Trade Monster. Daily data insights and ticker updates direct from three of the world's top TradFi, legal, and crypto experts on Bulls, Bears, and Blockchain every Monday and Friday on all your favorite platforms. Let's get started.
Good morning, good afternoon, good evening, depending on where you are and when you're listening. This is Revolution Radio's Bulls, Bears, and Blockchain. I'm Rob Nelson, and I'm joined by my team of market masters, John, Marc, and Alex, and Tom Essaye from the Sevens Report, who provides the Monday Global Macro Overview. You listen to hear the smart moves to make, and we're here to deliver just that. Great insights and info in half an hour. Hey guys, good to see you all. Now, full disclosure, John is still out globe-trotting, making money, living large, which we all do once in a while. So we're looking forward to having him back with us remotely next week. But we do have Tom Essaye of the Sevens Report, who does our Monday Global Macroeconomic 3-minute review. So Tom, good to have you with us filling in for John. Not that anyone can fill John's shoes, but we do what we can. I'm going to start out, and Alex and Marc, always good to see you guys. I'm going to start out, Tom. We're going to just talk a little about the volatility we've seen in the markets lately and kind of just sort of this week in the markets. And I'm sure Marc's going to have stuff to say about that too.
Hello, everybody. Thank you very much for having me on midweek. Yeah, I'm unfortunately going to be a poor replacement for John, but I'm going to do my best. So the markets have stayed volatile, haven't they? But they're for the same reasons that we talked about in the Monday show. The market is being forced to reprice the idea that the Fed is going to hike perhaps into the upper 5% range and that inflation isn't going to drop as fast as everybody had hoped. Much of the 2023 rally was based on those two assumptions. Those assumptions are still under siege this week, and so we shouldn't be surprised the S&P 500 dropped below 4,000 for the first time in almost a month.
And Marc, when you hear that, what does that say to you? I mean, and interesting sidebar we talked about before. You brought up the point that Goldman Sachs is talking about how hedge funds are sort of seeing the conditions sort of to leverage up more, meaning they think market conditions are good. Does that contradict what Tom's saying? You know, that they want to go more, into margins versus just cash to cash type things?
Yeah, there's no doubt, Rob, that is a contradictory indicator, and I am very loath and hesitant to be the bull to Tom's slightly bearish indication. Certainly, the bond market, as it did today, continues to scream the same signals that we talked about on the last show that Tom so astutely pointed out. But when I look at indicators like the smart money, the hedge funds, 2.3 trillion in total AUM of 730 some odd hedge funds that Goldman spoke to, indicating that they were literally backing up the truck, putting more leverage on or preparing from a leverage perspective to do some serious buying. So, that is an indication that some very smart money thinks that it might be time to start putting on some aggressive plays. And look, I totally agree. You asked Tom the question about volatility. Volatility will undoubtedly continue to be the theme of the next foreseeable quarters, as we have this epic battle between the bulls and the bears, equities and bonds, inflation, stagflation, interest rates, and the feckless Fed, and I'm still going to get royalties on that one, coining that last year, continuing to try to figure out how hard to put its foot on the gas without overstepping and pushing us into a stagflation condition. But I think there's more risk on indications, there's more bullish indications than bearish indications, and I'm hoping that the hard landing has already been overcome.
The feckless Fed. Alex, I always like to have you tie the crypto. And again, for anybody new listening, Alex comes out of the hedge fund world. But But, when you listen to them, what's the outlook in cryptos? Again, people are like, is it, are we done with the crypto winter? Obviously Bitcoin doing better, Ethereum, but overall it's still a kind of a dicey time, right?
Yeah, it is a dicey time, and I'm gonna have to go with Tom on this, because as much as I love and adore Mark, he's right on the fact that there's more risk on, but I feel the bearishness is still here. I mean, we had restated consumer spending numbers due to inflation, and the interest rate sensitive sectors are the ones getting hit. Interesting stat coming out today on new home mortgage applications being absolutely horrible. I'm not ready to do a reversal on being very cautious on what's to come in the first 2 quarters of this year. So with that, I'm less optimistic on us going into a bull cycle run with crypto than I am a bear at this.
And would that be, Alex, across the board? I mean, do blue chip currencies, for lack of a better word, blue chip cryptos like Bitcoin or Ethereum, do they stand apart from that, or is it all one big ship?
Yeah, no, it's across the board as far as I'm concerned. The first ones getting hit right now that I get a sense of are altcoins are beginning to tire. We also saw about 350 million in stable coins on exchange outflows, net outflows over the last 24 hours. The trend has been repeated throughout the week. That's telling me that people are de-risking and going to the sidelines with their portfolios for the moment.
All interesting stuff. Let's look at our picks from earlier this week. John's not here, so he doesn't get to play. But Alex and Mark, you guys both made 3 picks. And look, I'm a big believer. Unlike Kramer, we're going to look at the things that didn't go well as well. And everything was down of our 6 picks. Mark, Lucid, the EV car manufacturer, I'm guessing that was off a less than ideal earnings report. Give us the sort of the skinny on that. The non-gas powered skinny. I'm just stop making puns. And where you're at with it now, are you buy, sell, hold, so to speak?
Yeah. So listen, you can't get it right every time, and being forthright and considering where your calls are wrong is as important as patting yourself on the back when your calls are right. I was disappointed, as the street was. We saw some strong fundamentals that we were relying on as it relates to our expectation that Lucid was going to meet or exceed, or at least meet the street's expectations. They did manufacture more vehicles than they had predicted in Q4. They did manufacture more vehicles than they had set as their goal for the entirety of 2022. They did see more orders and less attrition, cancellation of orders than a lot of their competitors, and they are consistently gaining market share. But the street, I think, Rob, the street in a somewhat of a risk-off, a somewhat more suspect environment as a consequence of the FOMC minutes, as a consequence of the bond market indications, a lot of the bearish indications that my colleagues have been talking about so far on the show are part of what led to Lucid stock being beat up as bad as it was. I still think the prospects for this company are much better than a lot of its competitors. There's a lot of cash on the balance sheet. And if it continues to get beat up like this, I might look to add to my existing position.
So that's what I was going to ask you. And you say you might look to add to it. At this point, would you add to that position if you had? I mean, if you're holding it, what would you do? I'm not saying whether you are not, but.
Yeah, no. So we're going to monitor the price action, right? I mean, again, I think a lot of the headwinds that this stock and a lot of other stocks faced today were related to the headwinds in the broader market. We started off the day with some strength, but as we went, live with the Rebel's Edge show from the New York Stock Exchange today at 1:00, we started to see the market turn as a result of some of the macro concerns, again, that were expressed by some of my colleagues on the show thus far. So I'm going to look to see what the price action is in this name over the next 2 to 3 days going into next week, and see if we want to add to the position. If it recovers, we may not add to the position. Mm-hmm. It all depends. So this is a cautious wait and see, but I do think that this EV name holds a hell of a lot more promise than a lot of its progeny, not including Tesla in that. Tesla, sort of stands in a class of its own. but certainly versus a lot of its other EV also rans that are competing or looking to gain market share from Tesla.
And Marc, full disclosure, Marc's looking like a reborn Matthew Broderick, for us today, because you were just on the floor of the exchange shooting lots of content, and it's a good thing for listeners to know. You're on the floor a lot. You shoot content right there. Up against the big wall. You're right in the middle of it.
Yeah, it's a pleasure to do that. We have to thank our friends from thestreet.com. They have a terrific broadcast booth there that we collaborate with them on. And, look, I started my career there, Rob. I was a runner on the floor when I was just 18 years old, when we traded in fractions, used pens and papers, and you could still smoke cigarettes on the exchange. So it's always fun to get back to that iconic location.
Alex, there is no floor for crypto. Well, there may be a floor for crypto, but there's no physical trading floor for crypto. But you and I, we talked on Monday's show about Blur, an NFT marketplace, and obviously Blur took a little nosedive. What happened there, and what's your sense of it?
So, Rob, I have to agree with my colleague and my friend, Marc. It's very similar to his Lucid call that he did. Lucid is an up-and-comer in the EV market. There's a lot of room for the upside. It's outpacing its competition. And I think Marc was being gracious in saying, hey, Tesla's not in this category. It's in a category of its own. We all remember when Tesla was just like Lucid and even less. So, Blur, that's how I feel about it. It outpaced OpenSea in trading volume the last week. The one thing that's interesting note on Blur is that it came out, the creator of Blur is an anonymous person named Pac-Man. He's an MIT dropout and he's 24 years old. But this platform is already packed with advanced features that none of the others have. An aggregating order book system from multiple other venues, something you've never seen on NFTs. The trading is going through the roof. I believe in this. I wasn't looking to trade out of this on the dip. I wasn't looking to trade out of this in the short term. I, like Marc, if I had Lucid and I had Blur, I'm looking to keep this for a little bit, and I'm looking to reap the rewards of its progression.
Hey, Alex, is in this analogy, is Blur the Tesla? I mean, is OpenSea the Tesla of this equation?
Without a doubt, OpenSea is the Tesla. It's been the forefront the whole time. It's taken the market share. It's very easy to use. People flock to it. I would venture to guess that very few people have heard of Nifty Gateway, which is the Winklevi twins NFT acquisition, their marketplace that was purchased a handful of 3 years ago. About OpenSea is really the brand that's up front. Blur came out of nowhere and knocked it down with features, so I have high hopes for it.
And Alex, last question on this. Are we going to see a lot more interesting activity? I mean, I think we will in the NFT space as we start moving into more things like wearables, people doing shoots, right? We're moving from, just from the more mainstream use of NFTs as art and pictures to starting to see people starting to have like wearables, utilities and real estate. As that starts becoming a little more mainstream, right? That's going to boost even things like Blur, right? It's going to boost any marketplace.
I definitely think so. I mean, I know we're going to talk about something later on, which has to do with the PGA Tour, but that is the type of excitement that's coming. I sat down with the founder the other day of a new NFT project that's coming out where it is limited edition luxury pieces. Those are the type of things that are going to start coming into vogue, that are going to have a lot more utility, that are going to excite people. NFTs entered 2023 on a hot streak after being very dormant for Q3, Q4. So I'm excited for what this space has. I hope the momentum keeps carrying forward.
And we just announced, Alex, that I'm speaking along with friends like Anthony Scaramucci and others at NFT Miami. We just announced that yesterday, actually.
Marc, I want to ask you, when Alex talks about Blur having so many features and offering things that, OpenSea being the Tesla here, but doesn't have, is it a little similar with Lucid? I mean, does Lucid offer things that Tesla doesn't, that make it appealing longer term?
Well, listen, that's the theory, right? I mean, the other theory is the EV market is just too big for one competitor, Rob. And when you have a product as good as the Lucid, I don't know if you've seen any of the cars, they're absolutely beautiful. The customer service experience has been very strong. The quality has been very strong. And not everybody loves, the look of the Tesla. So I think, otherwise we'd still all be driving black Model A Fords because, that was what we all started with, right? You only needed one car, one color, one model, as long as it wasn't a horse and buggy. Well, I mean, the same thing applies to the EV space. So, and it's really a question, frankly speaking, not just of the features, the fit, the quality, and the appeal, the curb appeal. It's about the maturity of the business and whether you can be a legitimate auto manufacturer. That's one of the hardest things in the world to be, right? I mean, one of the other spaces that's as hard is to become an airline or manufacturer of aircraft. It's really effing hard to do it, and to do it at scale, and to do it at scale profitably. So, when we evaluate the runners up, or the ones that are trying to compete for the market share that Tesla is already well established, it's about things like the strength of the balance sheet, as well as the curb appeal and the quality of the product.
Let's bring Tom back into this. Let's hit a couple topics that we picked out to go through. And the first one is a macroeconomic-ish topic about GDP growth. Tom, I'll start the convo with you on this. But when we look at what's going on in the markets, and part of this ties to volatility. So I'd say volatility and the GDP growth, the estimates as well. How does that kind of play together, again, for the day-to-day investors?
Sure. So, let me first say that, I've been in this business a long time and been in a lot of media. And I have to say the conversations that I'm privy to here between Marc and Alex and John are really, really top notch. I mean, I'm more in the macro space, as you guys know, but hearing their granularity on names, their process, kind of how they back up their research, it's really, really top notch stuff. And I appreciate listening along when I'm not contributing. But getting back to my space, GDP is this very, kind of headline heavy number, right? And the financial media outlets talk a lot about it. For sort of everyday investors, it's not quite as critical as sometimes, our folks on TV will make it sound. But it does matter. And this week we got an important GDP update. So what happens is that you get two updates to the GDP report, the previous quarter's report. This week we got revised Q4 GDP. So we're talking about October, November, December. And there was a very clear message in the data. The economy is slowing, that growth is slowing, right? Growth is still positive, but it is slowing. And that contributed to the volatility, because at the end of the day, what are we talking about? Stagflation or not, right? I mean, whenever there's a hint of stagflation in the data, meaning growth is slowing or turns negative, but inflation is firm, you see stocks drop. The GDP data is really telling us that there is still a risk of stagflation. And again, that's the sort of the big discussion in the markets. Whenever we see data hint at stagflation, which is slowing growth or negative growth and stable or higher inflation, stocks and bonds get hit. So there's kind of nowhere to hide, right? When the data is the opposite, when we see growth stable but inflation declining, then risk assets, stocks and fixed income and bonds, they rally. First 6 weeks of the year, it was the opposite of stagflation, assets higher. Last 3 weeks, it's been hints of stagflation, continued this week. And obviously, we're seeing stocks and bonds drop.
So is any of this likely to change? I constantly read about people talking about maybe we're having rolling recessions. Maybe stagflation isn't what we thought stagflation was in the 70s. I mean, is there something to the argument that we're kind of in, not that economic cycles overall change, but that there's new metrics, new things that may not work out the way we used to see them, and the market's still catching up on that? Or is that just pie in the sky?
No, I don't think so. I mean, what is the old saying, right? History doesn't repeat, but it does rhyme. And I think that's what all of us are trying to figure out. It is a different economy than the 70s. It is a different economy than the 80s and 90s. It's a wildly different economy. We just got through 12, 13 years of QE, which until 12 or 13 years ago was a theoretical exercise on some college professor's whiteboard. And we've just done it for 12 or 13 years in levels that no one had possibly imagined. So how does all that intersect with what's happening with the economy. That's what all of us are trying to figure out. But, when I come back, I'm a simple guy. I too, like Mark, started my career on the floor of the exchange. I was a clerk for Merrill. And I was taught by the old timers there to keep things simple. And at the end of the day, the Fed is jacking rates up, 500-600 basis points in a year to 14 months. Perhaps the economy is strong enough to handle that increased weight. It may well be. But I think we've got some more bumps ahead before we can get to that conclusion.
Or Rob, the market's accurately, Tom, I should say, excuse me, the market's accurately pricing it in, right?
Yes.
I mean, isn't
Yes.
that the other factor? Like even if that's 100% correct, which it very well may be, and I can tell you one thing that's 100% correct is we are in for sustained volatility throughout the year. Does not mean that the risk on transition will continue. Doesn't mean that this won't still be opportunities to make money. I think there's opportunities to make a lot of money this year.
Yes.
But if the market gets it right, if the market prices this in, then maybe it doesn't matter as much. And Rob, just to give you my 2 cents to answer the question that you posed, and then we should probably move on to the next topic. My biggest issue is not only has the market changed, has the economy changed, has macroeconomic factors fundamentally changed, right? Including things like the employee or employee relationship, the nature of work, and things of that kind. But the Fed's got to stop relying on antiquated, delayed, stale data for decision-making. We have data that is available to us in real time that tells us what's going on with virtually every single metric that's important to the Fed and its decision-making, from the producer price index, consumer spending, credit card balances, employment, and things of that nature. We got to stop looking at data points that are a quarter or more stale in determining monetary policy. And I'm going to yell that from the rooftops until it changes.
Well said.
It's not seen in my lifetime.
Well said. It's time for Fed 2.0. Alex, bringing this full scale around to NVIDIA, which is an interesting company, right? So those who don't know, right, NVIDIA is a chip maker, makes pretty complex computing chips, was primarily being used in a lot of gaming applications as an Intel. And when Intel and AMD started seeing, too much inventory, that market started collapsing. NVIDIA's stock, is off the charts. It's doubled from its October low. And people are saying that a lot may have to do with the fact that AI requires a lot of computing power, and NVIDIA's chips would be good for that. And with everybody going AI crazy, and this gets into the should we be AI crazy convo, but just even starting with NVIDIA, and full disclosure on the end of that, people are saying, hey, it may be a little overvalued at this point, so expect it to start dropping back down. But it certainly had a good run.
Yeah, it's had a good run. I'm not sure that I'm not 100% convinced it's overvalued right now. Out of everybody on this panel and the shows we've done, I think I'm the least AI crazed out of everybody. So I'm not I'm watching as AI kind of matures, kind of like the interweb did back in '99. As far as did it drive it up, I want to pass this baton over to Mark. I know he has a consensus on it, and I respect his opinion a lot more than my own. So, Mark, please enlighten us.
Take it away, Mark. You're the contrarian a little on this.
Well, I'm a contrarian on AI. He's a contrarian on NVIDIA.
Well, and I don't even know that I'm a contrarian on NVIDIA. I just don't think – I think the AI theme as having been what propelled the stock price recently – is oversaid, right? I think it's a bit exaggerated. This is a company that's seeing continued sustained growth in its data center business, double-digit growth in its data center business, 11+% year over year. That does not require the explosion of AI. That does not require a return to cryptocurrency mining in the same way we saw it in 2021. This is just, we are creating data, and this our fans are probably going to be tired of hearing me talk about this, at an unprecedented and exponential rate. NVIDIA's stuff is really good for data centers, for managing, storing, doing the boring stuff with all the data that we create. And that, to me, was at the core of why NVIDIA came in at $6.05 billion in revenue for Q4 and an earnings per share of 88 cents, where the Wall Street consensus was a lot lower than that, right? So the AI and the generative AI stuff and how it's going to benefit NVIDIA, it will, but that's forward thinking. That's certainly not Q4. It's certainly not Q1 of this year, Q2 of this year, Q3 of this year. But even with all of this, I think the stock is still attractively priced. The thing that's hysterical to me about this, guys, and then I'll shut up, is the cacophony of analysts. And I had a lot of them around me, or their companies around me on the floor today, so I couldn't scream this on the other shows. But whether it was Credit Suisse, Goldman Sachs, Rosenblatt, or whoever, everybody jumping on the NVIDIA bandwagon and saying, no, this thing is a buy. It's a screaming buy. We have a $320 price target. We have a $360 price target. It's like, I would love to get paid that kind of money for coming up with those calls after the earnings are reported. We make money making those calls before the earnings come out. Now I'll shut up.
Well, that's a great point. And just, it's a much longer combo, which we don't have time for today. But Alex saying you're a contrarian on AI, just your bullet point on it, because, and I'm a bit of a sort of a, always try to see 20 years ahead. And I know you're not suggesting AI isn't going to be a powerful force in our future. But I think the mere fact that we're creating somewhat of a sort of an arms race between the big tech companies on this is going to accelerate the AI world a lot in the next 6-12 months.
Oh, I agree. I think the future is bright and it's bold and it's like conquering space. I'm not, I'm not excited about AI where it is right now. If I had to be just, granular about it, it's a very super algorithmic search engine at this point that doesn't go past, ChatGPT doesn't go past 2021 yet. So are we going to evolve from that? Are we going to be powerful? Should we be scared of, robot mutants taking over the world? Maybe. And I think that's, the AI is going to grow rapidly and make a lot of people a lot of money. I'm just saying for this iteration of AI, I'm not very excited about it, but I'm interested in seeing it work out the kinks.
Mm-hmm. So last topic, and then we're out of time. But Alex, you mentioned at the top of the show, and I just want to quickly touch on this DraftKings doing a PGA Tour NFT fantasy golf game. Basically, as I understand it, right, people could actually kind of compete for prize money via Polygon and NFT player cards, right? And DraftKings has long wanted to be in there, an obvious early mover. And I had one of the head of marketing tell me last year how much they were doing to gear up for the NFT space, and even on board people kind of like you'd have to opt to do it, but you could come in through a traditional credit card, right? It's a perfect space for a company like that.
Yeah, DraftKings partnered with the PGA Tour. They're launching this the Rainmakers NFT game. They're going to be digital cards tied to did I just say NFL? I'm sorry, PGA. It's going to be tied to PGA players, and you're going to be able to win money for millions of dollars, according to them. It is on the Polygon platform, which is really exciting. The Polygon ecosystem has had tremendous uprise over the last 2.5 years. A lot of people bullish on it. And again, like I said, the NFT market went to 2023 on a very heated note. It still is sustaining a lot of trading volume on the marketplaces, and I hope it continues. I think DraftKings exposure to it lets more of the everyday people get exposure to NFTs, and that's what's hot.
Yeah, and Marc, quickly to you, you have the Zombie Collective. You're in the NFT space. Shout out to the Zombie Collective. I'm guessing you would agree that things like DraftKings, sports, betting, fantasy, it's a great area for NFT adoption.
Yeah, I mean, it is. Look, we're in the era of NFT 2.0, right? It's not digital art for art's sake anymore. It's about utility. It's about using NFTs, which are just another expression of the incredible power of blockchain technology to take things that we've done the old-fashioned way, the Web 1 and Web 2 way, and bring it into Web 3. And we see continued adoption at scale from major brands, major corporations, major sports leagues like the PGA. That's a big effing deal. A BFD, as I told our viewers this morning, that's a technical term. It's a trader's term. That is a big deal. And so I think when we consider and we understand what this stuff is about, We need to separate the crypto FUD, the crypto ice age, thanks to SBF and his progeny of fraudsters, and understand that there's a difference between that, and not all crypto's bad, by the way, but there's a difference between that and blockchain. NFTs properly utilized are an expression of the power of blockchain technology, and we'll continue to see adoption.
Mm-hmm.
Wow. That was so well worded. I loved it, Mark.
It was awesome.
It may not be the first time I've said that, but
hey, Rob, do you mind if I ask one, and then I'm going to be quiet and you do what you got to do? I have one thing for both Tom and Mark that I really want to get out of the way.
Okay.
Morgan Stanley, we're talking about the economy, and Mark is a very happy person. Tom is talking some, maybe some bearish facts that he's seeing, but Morgan Stanley sees the S&P 500 losing, what do they say, 26% in the first half of this year. Tom, what's your expectation of that becoming a reality?
Mike Wilson easily gets Analyst of the Year award for 2022. He called it and he nailed it. He was also quite bearish for at least a year before that, if not two and more. So, I'm a bit skeptical about them doubling down on this. I think if you see the S&P 500 drop 26%, then, the Fed will be at least 100 to 150 basis points higher. I think we're going to be in a nasty recession, easily a 10 to 20% drop in S&P 500 earnings. Is that all possible? Sure it is. I just think I'm as skeptical about that as I am about us hitting 4,800. I think to Mark's point, part of the answer to this is that we chop from 3,800 to 4,100, and we just kind of get cut to pieces a little bit unless you're a good trader, and there will be market making opportunities. But I'm not that bearish.
I tend to be more of a Tom Lee than a Wilson, more of a fun strat than a Morgan Stanley. And Tom's a good friend and I think one of the best market strategists out there. People accuse him of being a permabull. People accuse me of being a permabull, but I'm not quite as sanguine as today, Alex. Of what Alex has just suggested, citing that report from Morgan Stanley, it's going to be the chop. I think Tom said it best. It's going to be the chop. Volatility will reign throughout the year. So be prepared for that. Understand how to trade around it. If you don't know how to trade around it, trade for the long term. Buy stuff that you think is cheap now that you'll be happy to own at these levels in a year or 2 years from. But that's what we're in for. But I'm nowhere near as bearish as what that Morgan Stanley.
Well, great stuff, you guys. Good show. We'll have John back with us next week, and on our Monday show, Tom Essaye will also join us for that. And you guys can look up permabull, Mark's word, if you don't know what it means. It's a good one. Alex, Mark, Tom Essaye, thank you guys. Great show. See you all on Monday.
Thank you.
Thank you, everybody.
This episode of Bulls, Bears, and Blockchain is proudly brought to you by Verijet, the only solution for short-haul private aviation. To learn more, go to verijet.com. Thanks for joining Rob Nelson, Alex Mascioli, Marc LoPresti, and John Najarian with another great episode of Bulls, Bears, and Blockchain, twice a week on Revolution Radio. Whether you're new to the world of Web3 finance or an experienced investor, we've got you covered. Follow us on Twitter at GetRevRadio and visit our website at revolutionradio.io, helping you make smarter financial decisions.